Hi everybody, welcome along. We're just going to give you a couple of minutes to get set and then we'll get started in a minute or so. So just going to give everybody one more minute to get everybody checked in and then we'll get started. Okay, we'll get started. Welcome everyone to the Evalesco and Australian Advice Network webinar on the future of investing. My name's Jeff Thurrock. I'm one of the directors of Evalesco and of AAN. And you can see in the corner of your screen, Francyne Mu from Franklin Templeton, who I'll introduce to you properly shortly. So we've decided to turn our video on today. And as I was saying earlier to Francine, my kids commented it was the first time they've seen me in a proper shirt for a while, so I've got dressed up for the occasion as well. Francine and I are sitting comfortably in our homes, so hopefully you're comfortable and safe and warm as well. So our video is turned on, your video is turned off, and you're also on mute so that we can't see or hear you for the duration of the webinar. However, we do encourage you to ask questions as we go along today, and you can do this by clicking on the Q&A tab that you can see there at the bottom of the screen. So type in any questions and we will endeavour to get through those throughout the presentation, and if not, we'll come back to them at the end where possible. So before I launch in and introduce Francine and we get started, it's important to point out that even though all, or at least most of you on this webinar are clients of Australian Advice Network and Evalesco, the information provided in the next 45 minutes doesn't specifically consider each of your individual circumstances. So it isn't personal advice. If you think you should be acting on something that we speak about and discuss today, please speak with your advisor first before acting on that. So as I've already said, I'm really pleased to be joined today and welcome Francyne Mu. So thanks for being with us, Francine.
Thank you.
So a quick intro for Francine. So Francine is a Vice President, Portfolio Manager and Research Analyst for Franklin Equity Group. Prior to joining Franklin Templeton in 2008, Francine was a Senior Investment Manager at Pictet Asset Management and a Vice President at Citigroup Asset Management covering financials. So she entered the financial services industry in 2000, and Francine holds a BA and a BCom with honours from the University of Melbourne, and she's a chartered financial analyst. So as I said, welcome along, Francine. So Francine, to get us started, would you mind telling us a little bit about Franklin Templeton and the Franklin Global Fund?
Sure. On the next slide, you can actually see that well, Franklin Templeton is a global asset management firm. We've got about 580 billion in assets under management. We've been around for around 70 years and are in 34 countries. We run many different strategies across fixed income, equities, and alternatives. And you may have heard that we recently announced the acquisition of Legg Mason, which will add further capability to our platform. As a firm, we've got about 6 billion of cash on balance sheets, so we're fairly well capitalised relative to the industry. We've got presence in Australia. We're largely in the US, and we're basically a large firm that has local presence.
And so your role as part of the global fund, you have a lot of interaction with people from other parts of the world and your colleagues in those other countries?
Yeah, no, that's correct. Although I'm based in Sydney, I cover global equities. So, from the US to Asia to Europe. I apologize for my voice today, but, I'm feeling a bit croaky, having been up in the evenings just speaking to some companies in the US, and it'll be the same tonight as well. I guess my role as a PM, and also as an analyst, is to really look at companies, look at new investment ideas. Keeping abreast of the news, the day-to-day news, but really trying to understand what the underlying trends are and separating that from the market noise. So, I'm looking at sort of existing positions that we hold in the portfolio, making sure that those companies are, tracking as they're supposed to, but also looking at new investment ideas, where we can deploy capital, going forward. And in doing that, I'm speaking to companies and management teams. I'm, speaking to the suppliers, competitors, as well as customers, to try and gauge the merits of a new investment in a particular company. So I guess in many ways, I'm trying to find a needle in a haystack, but it's that love of investing, and looking at companies and seeing how they grow over time is really what drives us and, drives my work as part of the team.
Fantastic. We've got a bit of a overview of your team on the next slide here as well. So how do you interact, and how does that come together to I guess get the portfolio put together?
So I work in the Franklin Global Growth team, which manages around about 10 billion in Australian dollars. We're a team of 11 professionals with the sole focus of looking at global equities. So we like to sort of think of ourselves as a boutique team within a larger sort of Franklin Templeton organization. With that has many benefits in terms of shared services across the Franklin Templeton platform. We've got good access to sales and marketing and distribution teams, also the trading and the back office functions, which really leaves us to, focus on what we're good at in terms of, looking at, investment ideas and the global markets. So the team is led by John Remmett and Don Huber. And we're a team of seasoned analysts, each focusing on the different and the main sectors. We've got an average of around 20 years plus in terms of industry experience. And the team has, for the most part, been working together for the past decade. Most of us have been on the team for the last 11 years. So, the track record is really the team's track record. And we're a very nimble team, I think, in terms of being able to respond to, what's happening in the global environment, but also, we're very focused in terms of global equities and this particular strategy, and just finding ideas to sort of, hopefully, outperform over the long term. I started with the team in 2008. Just before the financial crisis, as a financials analyst, actually, which was an interesting time. But it just goes to show you that, we've seen many crises before, and, managed to move to Sydney in 2013. As you can probably tell through my croaky voice, I'm Australian, so I was very lucky to continue working with the same team. And being able to do that. So the rest of the team is in New York, and, in the long calls, in the evenings, is to sort of catch up with the team itself and to sort of keep those communication lines open, and to also just to catch up with, a lot of the companies which are obviously domiciled in the US, in Europe, or in Asia.
Mm-hmm. So you've been pretty used to that remote working arrangement that we're all adjusting to over the last couple of months. Correct.
Actually, it's been fairly seamless for me. Obviously we have an office in Sydney, and I do sort of go in, but I'm quite used to sort of working from home and, all hours in the evening. So,
Yeah.
yeah.
And so when you mentioned talking to the company, so how many companies would you talk to on a regular basis or over a year? And what sort of things do you talk about?
So each of the, as my role as an analyst, we sort of have about 8 to 10 names within the portfolio, give or take. And we're also, at a point in time looking at many other new sort of investment ideas. So really, when we're talking to companies, we're trying to sort of better understand what their strategy is, what their competitive positioning is. And of course, companies and management teams, they like to sort of put their best foot forward and tell you, what you want to hear. So we often actually fact check, looking at the competitors in the space, and also speaking to the suppliers and competitors and customers to really gauge, a 360 view of the company, and to really understand, the competitive advantage and competitive moat. And then, really, we're just trying, obviously in the current COVID environment, really keeping abreast with, what they're trying to do, whether or not they've drawn down on, debt lines, what their view is in terms of conserving cash and capital, and also what they're doing in terms of trying to sort of keep on top of their costs in an environment where the economies have closed down. So it's really just trying to understand what they're doing in the current environment to sort of and whether or not they're seeing opportunities for growth, because a lot of the names that we hold in the portfolio are fairly well positioned and have good secular growth drivers, and so they're actually fairly well capitalized, and so a lot of them have actually raised capital in anticipation of deals to be done, over the next, little while.
Fantastic. So that leads us a little bit into, I know the next couple of slides we've got talk about the investment philosophy, investment strategy of the fund. So can you talk us through a few of these points, please?
So yeah, of course. I think our investment strategy is fairly simple and really can be summed up in this slide. As I mentioned before, we pride ourselves in terms of the research depth rather than breadth. So we really get to sort of understand and kick the tires in terms of the company, where the investment ideas are strategic in nature and not opportunistic. So we basically hold 35 to 40 names, good companies which we will believe will outperform over the long term. We're very sort of long-term focused. So our typical holding period is around, 4+ years, although we do have some names in the portfolio that we've held, for the last 5 to 8 years. So we're really sort of looking over the long term and looking through, I guess, a lot of the market noise and trying to find those best ideas that will outperform over that time period. And how I think we manage risk is different to other managers. Because what we're trying to do is to find those 35, 40 names which have earning streams that are not highly correlated to each other. So if you think of the Australian market, in the Australian market context, if we were interested in the banks, we wouldn't buy, 2 or 3 of the banks in the portfolio. We've only got 35 to 40 names. And if we were really sort of, convinced of, Australian banks being the best idea, we'd only hold one of those names, because we think holding 2 of them would be doubling up on the risk that we would be taking in a portfolio of 35 to 40 names. But, having said that, we can invest anywhere in the world, and we can invest up to 20% in emerging markets, although our current weighting towards emerging markets is less than 10%. Mm-hmm. So, in summary, it's 35, 40 names, long-term investment horizon, really picking names that can grow over the long term and names which are not correlated with each other. So if there is an issue with any of those names, there's not a sort of domino effect that cascades through the portfolio.
Okay.
Mm-hmm.
So it's a global portfolio. Do you look at Australian companies or?
We have actually, although in this strategy it's ex-Australia, but in our other global portfolios, we actually do hold names like CSL and Cochlear, which are sort of well positioned, globally, and are fantastic Australian companies. So we do look at Australian names. It's just that at this point in time, our 35 and 40 names in this particular portfolio, we're not holding any of those Aussie names currently.
Mm-hmm. And you also, in that context, talk about search without borders. So there's not a lot of specific focus on any geographical areas or trying to diversify. It's more finding the right companies. Is that fair to say?
Yeah, it's really, from the bottom up. So we're not sort of taking a top-down view in terms of, focusing on a particular, region and then sort of drilling down that way. The analyst team is, quite seasoned. So they've been looking, in their sort of sectors for a very long period of time. And so we tend to sort of try and find, the economic value within supply chains across industries and try and drill down in those areas. So an example would be, we wouldn't hold, I guess, auto companies, auto manufacturers, because we don't believe that, apart from brand, there's not really that much of differentiation across each of those auto companies, but rather we would look at an auto supplier or a software provider into those auto companies, for example, like Aptiv, which, has good secular support in terms of, the electrification of cars and also the increasing content per vehicle within a car. So we're not taking, I guess, a view of whether or not BMW can outperform Toyota or Tesla or what have you, but, we're buying an auto supplier that feeds into all of those auto manufacturers and can sort of, benefit from, the increasing electrification of vehicles over time.
Great, thank you. So this talks a little bit about some of the things you've run through there, but perhaps a little bit more detail on how you specifically look at those companies, so as you call it, the stock selection discipline.
Yeah, sure. So, I mean, what do we look for in companies? Well, we look at growth, quality, and valuation. We look for companies in terms of growth that have a sustainable business model with a strong competitive advantage. Typically, we like companies that can generate strong free cash flow. And this has been really helpful, I guess, in the current environment where, I guess those companies which are much more leveraged up during COVID have had issues in terms of liquidity and also in terms of their debt covenants. So our companies, by and large, have not had any of those issues simply because they're strong, very strong in terms of free cash flow generation and, haven't really need to tap debt markets or banking loans in order to grow over time. We also...
You've got the value generating reinvestment. How do you see the potential reduction in dividends that some companies are paying and that sort of thing being impacted in your portfolio or generally?
Well, generally because I guess our strategy has more of a growth bent. A lot of our companies don't pay too much in the way of dividends. And I know obviously in the Australian market, we love dividends because, it's very tax effective. It's not so much the case for international markets. For example, in the US, a lot of the companies prefer to do buybacks. And it's on average, dividend payout ratios are around, 15 to sort of 20%. Rather than, the sort of 50 to sort of, 60% that we sort of see, I think, for Australian companies. So, and also given the fact that, the companies that we're looking for as sort of higher growing to sort of steady growing companies, a lot of them sort of practice reinvesting back into the business. And often we see that through, developing new revenue streams so they can sort of support, further growth in the future or perhaps, going into a different vertical. So we haven't really seen that much in the way of, stopping dividends or, sort of, withdrawing dividends as perhaps we've seen in the Australian market. But, there's definitely has been a move in terms of conserving cash in the current environment, whereby, obviously, discretionary spend and, the items like that, that, companies have sort of taken sort of more of a conservative view in terms of how they sort of manage that. So there has been definitely that trend across the companies that we hold in our portfolio.
Okay, great.
Yeah. I guess in terms of quality, we're looking for companies with strong financial transparency and accounting and, really strong corporate governance. So if you think about, compensation structures, we go fairly deep into those to try and understand how management teams are, incentivized and what they're looking for in terms of, growth going forward. So, we don't like companies that sort of just do M&A for the sake of M&A. We want to see sort of expansion in terms of their margins and in terms of profitability over time. And we sort of check compensation structures for the management teams to ensure that that's aligned with our interests as shareholders.
Mm-hmm.
We also look at, ESG as a matter of course, but particularly on governance, which is very important to us. And things like that, looking at, voting rights across key managers or key management teams, keeps us away from companies like, Facebook. That may be a great company, but Mark Zuckerberg is, the key man there. And, as shareholders, we don't have much of a voting right, from that point of view. So we haven't, invested in names like that.
And just on that, how often do you get involved in, I guess, corporate actions or agitating around boards or changes in that regard?
Sure. I mean, we're not sort of activist investors by any means, but, we certainly make it known if, on a corporate governance point of view, we're unhappy, or even from a compensation point of view, we're unhappy with the packages that have been put forward, or, we require more transparency in terms of how the managers actually get paid. So we definitely have, reflect that through, proxy votings and things like that. And also, importantly, engaging with the companies themselves in trying to sort of put our, point of view forward. Recently, I think one of our companies had certain board members, which were sort of legacy board members in terms of, the old sort of private equity holdings that they had. And we were quite vocal in terms of, why they still had those board seats whilst, the private equity stakes had been sold. And so the companies were, very open to our point of view and, see it as a concern that we have had. Mm-hmm. Also, in terms of the consumer side, there's been a lot of complaints, and ESG factors involving, how staff are treated in warehouses, and also just labor costs, in China and in other countries, sort of. And we've been very vocal also in terms of, basically getting the company to sort of clean up their act, in terms of, that sort of environmental and that social element, in terms of improving the sort of conditions for their workers, where they sort of manufacture. So we do engage, but we're not activists, by any means.
Great. Okay. That makes sense.
And then lastly, I guess in terms of valuation, what we're really trying to do here is look at valuation on a relative basis. So all our analysts build, in-depth models to conduct scenario analysis. We sort of build discounted cash flow models, as well as use dividend discount models to gauge valuation, to ensure that we're not overpaying for growth and quality. For the recent COVID situation, we spent a large part of our time retesting our investment thesis, looking at the capital and liquidity flexibility for our companies, and also stress testing our valuations, in terms of like if there's a company that's closed its doors because they've had to in terms of social distancing and, restrictions, just to play out the scenario analysis on that front to sort of ensure that we're comfortable with the valuation and where the what's being priced in terms of the company currently. So, on that basis, and after that exercise, we remain fairly comfortable with the names that we hold in our portfolio.
Okay. So speaking of that, we've got on the next slide some of the top 10 holdings, and I love the stock stories, as I told you, so I'm sure we can talk about a few of these in detail, but This is an interesting slide that sort of shows your top 10 holdings versus the index and how it's quite different.
Yeah. So I think one of the key differentiators of our strategy and what we're really trying to do is to find, I guess, less well names or less sort of discovered names, I guess, in our portfolio, and basically, try and find names which are sort of earlier in their growth trajectory. So if you sort of compare our top 10 names with the top 10 names in the index and relative to some of our other global peers, you won't find many names that are sort of household names. But having said that, if you look at, the names that we have, Equinix, CoStar, The Risk, Synopsys, these are, still fairly large cap names in the, relative to, I guess, to the Australian market. So if you look at Equinix, which is our top holding position currently, that's actually a 62 billion market cap name. Regeneron, which is actually through this COVID environment has developed, or repurposed one of their sort of drugs for the treatment of COVID in the later stages, is a 62 billion market cap name. Obviously Visa, everyone knows, but Danaher is like 120 billion market cap name. CoStar, The Risk, Synopsys, they've got 30 billion in terms of market cap. Salesforce, most people know, 160 billion. Aspen Tech is a smaller name, around 7 billion, and the ICE is around 60 billion in terms of market cap. So whilst they're
businesses,
yeah, definitely, and whilst they're not well known, I think that's our sweet spot between those sort of 5 billion to 50 billion, market cap name. 60% or 2/3 of our portfolio are in names which sort of play in that space. And then if you look at the index, obviously, you can sort of see the household names and the mega caps, Microsoft, Apple, Amazon, Google, Alphabet, Facebook, JP Morgan. You can sort of see that they're sort of the household names and the names that everyone is familiar with. But importantly as well, if you look across our sort of top 10 holdings, 1/3 of the names, the top 10 holdings make up 1/3 of our portfolio, whereas in the index, you see the top 10 holdings is around 16% of the portfolio of the index. So basically, we're trying to sort of take concentrated positions, in our portfolio and sort of populate our portfolio with differentiated names that are sort of less well known and less well discovered. And so, I think in the current market environment, obviously we've seen a fair bit of market volatility. The year started fairly well, January, February, and by the end of January, we were kind of sort of had an inkling that basically the coronavirus was going to be something more than just, contained in China. And so by late February, I think it was clear to the market that it was going to be a global pandemic. So you can sort of track the indices, and you can sort of see that, by February 20 was pretty much the peak of the market. Yep. And then after that, I guess until, March 20, a month later, the market fell 22%. And the ASX actually fell by a larger amount, down 32% over that time period. But I think with, following from the global financial crisis, we've sort of seen central banks and governments, they've worked fairly swiftly in terms of announcing support, whether or not it's on a monetary basis or a fiscal basis, which has seen good market support and a bounce back in markets as of, March 23rd. And we've seen, the MSCI World bounce back 18%, and the ASX actually, 200 bouncing up 35%. So, we've almost recovered all the losses that we've seen year to date. The ASX 200 is only down 6%, I think, and MSCI World ex Australia is down 2%. So it's been a fairly volatile market, but we've really stuck to the playbook, which is we like the names that we have in the portfolio. We've not really made many changes to the portfolio, except for rebalancing out of the names that have performed well to names that have performed less well. Again, I'd like to say that we're sort of more strategic in nature rather than opportunistic, because we know that in markets of high volatility, people can be whipsawed in that environment. And so we've really just stuck to our guns and stuck to the sort of playbook that we had back in 2008, 2009, and just really have sort of held, the names that we have had, rebalanced, a bit on the side, but, that's really placed the portfolio in a good position in the current market environment.
Fantastic. Before we drill into a couple of those specific companies and tell some stories, we've had a question come through. Thank you, Russell, for asking the question. How does currency affect the portfolio, and how has the fluctuation of the Aussie dollar affect your thinking and the actual performance of the portfolio?
Sure. I mean, I guess in terms of how we view, the portfolio, it's really, from a bottom up. We're not specialists at all in terms of forecasting currencies. We tend to think that over the long term, it's kind of, it's a zero sum game. So if there's any sort of currency, that impacts our companies themselves, we're using sort of, market forecasts. We don't have any insight on the back of that, and we don't hedge on that basis either. But in terms of, if there are sort of currency exposure, for example, a company that sort of basically operates in Australia, there's obviously translation risk that is to be had, but we don't try and hedge for that.
Okay, thank you.
Yeah.
So we might flick on to the next slide and talk about a couple of the companies that are in the portfolio at the moment.
Yep. So, in terms of the COVID scenario, obviously, it's sort of increased adoption and increasing working from home. And, we've sort of seen a trend, I guess, in terms of security in the cloud as being sort of a long-term trend. And I think Zscaler actually plays quite well in the current environment and also over the long term. It's definitely a disruptor in that world. It's a $14 billion market cap name, and it provides security software in the cloud for companies. So with working from home, basically this phenomena has basically accelerated the focus on security. So previously, with everyone going back into the office, there were basically, perimeters, security perimeters that could sort of ensure the safety of and security of networks. With working from home, it actually, changes the dynamic to a certain extent and throws up, I think, some gaps in the perimeter and in terms of how networks are sort of managed. And so, Zscaler actually helps companies to sort of manage that, whether or not you're sort of accessing corporate networks from a device, from your desktop, from an iPad, what have you. It provides that added layer of security as you sort of work and access stuff from the cloud. I think under the old castle and moat security system, once a password was compromised, a hacker or an external sort of person could actually have free roam within the security network. Whereas I think under Zscaler, in terms of their security architecture, it's a zero trust exchange network. So you have sort of authentication at every step of the way. It's really a disruptor for, and I think will continue to take sort of market share away from the, Cisco VPNs. And so, over the last couple of years, you can sort of see in that graph, in terms of billings and in terms of revenue, it's grown very strongly, up 50 to 60%, and has continued to do so, over the last quarter during the sort of working from home phenomena, as, has increased over this COVID environment. So, we continue to like the story. We think it's a company that's been well positioned and will continue to sort of disrupt the sort of incumbents in the industry, and be, a security provider, a security software provider of choice. They sort of work with a lot of the big names out there in terms of, the Amazons and the sort of Microsofts out there, in protecting Amazon Web Services and also Azure, and things like that. So we continue to like the story and think it's well positioned going forward.
Fantastic.
Mm-hmm.
The next one is one that people have probably heard of.
Yes. I mean, I think there are sort of a number of names which we like in the portfolio that have benefited from the shift from bricks and mortar to e-commerce. And Shopify and Mercado Libre are two of them that we hold in the portfolio. And Shopify is an $88 billion market cap company to date. So, it's done fairly well in terms of their ability to sort of penetrate merchants. I think with e-commerce, we've seen in the past, a lot of the sort of larger retailers sort of pour money into that space, whereas I think the SME market has been left behind, although now increasingly, getting online. And Shopify is a one-stop shop solution for SME businesses to build a presence online. They've been increasingly important in the current environment where consumer-facing businesses have been closed down. So it's a platform that essentially helps businesses build their websites, link to payment options, provides access into social media platforms such as Facebook and Instagram, excuse me, helps companies manage their inventory, promotions, order management, and also increasingly the fulfillment side. So the business has definitely benefited from the closure of bricks and mortar in the current market environment, and is also increasing, from the adoption of e-commerce. To name a few, I guess, in the Australian market context, Harris Farm, and if you've bought anything online from jbhifi.com.au, these companies are sort of powered by Shopify. Right. And so we continue to like the story as they continue to sort of penetrate the merchant base. And, you can see the market, the global e-commerce market is huge. It's probably, 1.3 trillion ex-China. And Shopify has only got 3% market share, of that currently, and we expect that to continue over time. Another name that we think will do well in the current market environment, and in just generally the digitization of platforms is CoStar Group. I liken the name to a certain extent to realestate.com.au, but it's very specialized in terms of its exposure to the commercial real estate market in the US. It also has exposure to the multifamily market, rental market in the US. And so I think the US is fairly behind, behind in terms of, commercial real estate transactions. It's very sort of paper intensive. And so this company with, the 30 years of data and analytics that it has, basically is now putting everything online and helping the sort of commercial real estate market transact in a less, in a more frictionless manner, I guess. And obviously, in the current market environment, we're bound to sort of see some of the, commercial real estate players kind of fall in terms of, rents not being paid, the debt that they have on balance sheet. And so CoStar, I think, is actually going to be a more useful tool, and it will actually increase adoption, I think, of their data and analytics, because, distressed market players, if they're buying into, if they're seeing the current market as an opportunity to sort of buy into commercial real estate, whether or not it's warehousing, office, retail space or what have you, they will need to pull that data down from CoStar. And you can sort of see, a lot of these sort of industry players, whether or not it's CBRE, whether or not it's banks like UBS or other players like that, ING or what have you, Colliers. They're all looking and they're already clients of CoStar Group in terms of trying to sort of understand where their portfolio is at in terms of vacancies, mark to market of their portfolio, what sort of buildings have been transacted for. They pull down the CoStar suite of products. And also in the rental market, which they're sort of fairly new in, the sort of multi-family rental market. They sort of entered that market in 2015. They were one of many players in that market back then, and now they're the only player. We've seen a lot of their competitors fall. In fact, CoStar had just announced an acquisition of RentPath, which is one of their key, or the number 2 player in the market. And that is now going through to FTC approval over by August basically. And so I think in the current market dislocation, you've seen a lot of their competitors fall away, and the opportunity for them to sort of further consolidate the market. Their total addressable market is huge. You can sort of see that it's 18 billion plus currently, and they only have 10% of the market. And with further market consolidation, I think CoStar can grow to sort of take further market share as this sort of as they sort of emerge from this COVID period. But it is interesting, you sort of talk about a lot of companies in distress and drawing down on debt lines and raising capital because they need to. CoStar's share prices, basically continued to go from strength to strength, and have actually taken the opportunity to raise capital in anticipation of further deals.
Right.
In speaking to the company last week, they're not there yet in terms of, we're not there in terms of, distressed assets in commercial real estate as yet, because there's been a lot of, rental holiday periods. And so we're not seeing that sort of bankruptcies as yet, but I think they're expecting that to sort of come in the US market over the next 6 to 9 month period. And so they're well positioned. They've created, they've got this war chest, and they will go out and further consolidate the market going forward.
Okay.
Yeah.
Interesting. So we've got about 5 minutes to go.
Oh,
so might quickly touch on the next story, but then I want to make sure we get to the bubble slide and have a talk about that as well. So.
Sure. I mean, I guess TAL, I've spoken about TAL, many times before. It's basically, obviously with the current COVID situation, a lot of school closures and what have you. TAL operates, after school tutoring, and, they've been fairly well positioned because of the investments that they've made over the last couple of years in terms of, online offerings. And so when the school closures happened in China, and, they're only starting to sort of reopen now. They basically closed at the end of January after Chinese New Year. TAL has benefited from, increasing student enrollments as, parents are being driven mad with, school kids at home, wanting them for something to do. I can vouch for that. But, you know, basically their online learning modules have been, you know, hugely rewarded in this current COVID environment, and they've seen their student enrollments increased markedly. And, you know, again, a lot of the smaller players, the mum and pop tutoring companies, have not been able to sort of keep up with TAL, and so we'll continue to see TAL, you know, win market share over time.
Mm-hmm. Great.
So
I know we've got a couple of minutes to go. We've got a couple of questions that come through as well, but I just wanted to make sure we got to this slide because you and I have spoken about this is a great illustration of the philosophy and how you approach picking the individual companies that you put into the portfolio.
Yeah, so I think, you know, this is just going back to, you know, I guess trying to illustrate how we manage risk in the portfolio. So we're looking for 35 to 40 names, but we want those 35 to 40 names not to be correlated to each other. So when a scenario, I mean, and no one ever forecasts a pandemic, right? But when a scenario such as COVID hits, we're able to withstand, you know, the hit to the markets, given that, you know, while some consumer-facing names have, you know, potentially found it more difficult, the other names in our portfolio have flourished in the current market environment. So we really don't want that sort of domino effect cascading across the portfolio. And essentially, that's how, you know, we've managed the risk in the portfolio. And, you know, really, we're just trying to sort of, you know, choose names that are not highly correlated with each other so they can withstand market shocks.
Mm-hmm. One of the questions that came through from Mark, and thanks Mark for the question, was you mentioned less than 10% of the portfolio is in emerging markets. What are some of the emerging markets that the companies are domiciled in? And this might be a way of, you know, pointing to the ones and where they are.
Yeah, sure. So as I mentioned before, TAL Education Group is 100% of their business is in China. And also Mercado Libre, which is basically listed in the US, headquartered in Argentina, but the bulk of their business is actually in Brazil. And despite all the issues in Brazil that we're seeing, obviously, you know, that the sort of COVID infection rates sort of came later to Brazil, and they're sort of sorting through that now. You know, the country is still kind of in semi-lockdown, depending on what Bolsonaro does. But, you know, the market, you know, place for e-commerce has gone from strength to strength. And, you know, Mercado Libre has, you know, continued to do well in that market environment where, you know, it's an e-commerce provider, you know, platform in the Latin American markets, and has continued to do well where, you know, bricks and mortar shops and have essentially closed down. So that is also, you know, I mean, they're essentially our two names in emerging markets.
Okay, great.
Yeah.
Fantastic. Is there anything else you wanted to add on this slide, or should we?
No, I think, you know, we're fairly comfortable in our positioning in the current market. You know, we have sort of, as I mentioned earlier, sort of rebalanced from names which have done less well to sort of names which have performed well in the current market environment. But, you know, we're long-term investors, and we've been strategic in our approach, and, you know, really have not made any sort of significant changes to the portfolio at all over this time period.
Yeah, fantastic. I think that's, I'm just going to flick through to the end there because we're out of time, and no more questions have come through. So I think that's one of the key things that stands out to me about, you know, I mentioned in the intro that looking at how professional investors and what they can do, and we talked about that in the invite, it's really interesting to see that you haven't made a lot of changes, even though there has been so much turmoil and volatility in the market. We saw a lot of, couple of reports come out, and ASIC putting out warnings to Australian investors who'd reopened their share trading accounts or taking on the day trading as a way of trading through the volatility and thinking they could make some money out of that. Whereas the professional investors like Franklin Templeton have been sticking to your knitting and sticking to the philosophy, which is borne out pretty strongly, which is great. I think the other key takeout is, you know, the names that you've got in your portfolio are large companies, but they're not household names to us. So for somebody who was to look to go and invest in that sort of sector, much harder to get access to the information that you can and the insight that you're able to get into those companies in such I guess, a diverse range of industries and geographies as well. So certainly one of the reasons that we feel very comfortable having you and your team managing our clients' money in that space.
Thanks very much, Jeff, for the opportunity to speak today. And, we love what we do. And, our aim really is to find investment ideas that outperform over the long term, and to sort of, keep an eye in, to ensure that the companies, are not highly correlated with each other, so that, when these market shocks do happen, the portfolio is in a relatively good position, over the long term.
Fantastic. We've had one more question come back as well, but we'll come back to that one offline. I'll talk to Francine and we'll get you some info on that one offline, Mark, as well.
Okay, great.
So in the interest of time, thanks very much, Francine. That was fantastic. Really appreciate you giving us your time. Hopefully your voice held up well.
Yeah,
hopefully it hasn't wrecked it for the rest of your day.
Yep.
But to everybody who was listening, thank you very much for joining us today as well. We'll be making these slides and the recording of the conversation available on our website from this afternoon. So if you look at the events page on our website, you'll see this recording as well as previous webinars come available from this afternoon. So go and have another listen if you want to recap the highlights, of which there were many from Francine's talk over the last 45 minutes. So I'll leave it there, and until next time, I hope everybody stays healthy, wealthy and happy, and thanks again, Francine.
Thank you. Thanks very much.